welcome to the first webinar of the BDO Tech Support for Professionals Tax Update series for the autumn. I'm Malcolm Pengelly and I'm your chairman for this morning. Could we have the next slide, please, Jordan? So what are we going to cover today? I'm joined by a couple of people who haven't made it to the slide, but you'll know them very well. Sadiq Hashmi and Rob Edwards. So they're going to update you on the latest tax news. Sadiq's a direct tax consultant on the tax line, and Rob is a VAT specialist. I'm sure many of you will have spoken to them directly. Our first major topic is what to look out for when selling a business, and we're very pleased to have as our two speakers, Paul Townsend, who's a partner dealing with all aspects of UK tax planning for owner-managed businesses, and he's joined by his colleague Ashley Palfreyman, and I'm sure they've got some really interesting comments on what to look out for when you're selling your business. And our second topic is the upcoming changes to the Nom Domicile regime, and Radhika's going to take us through what we know so far and what we're likely to expect at the budget. And finally, from me, there'll be opportunities to post questions in the Q&A, please, not the chat, in the Q&A, and we'll pick those up at the end of each session. And any we haven't been able to deal with at the end of each session, we'll pick up right at the end under item 4 on the agenda, Q&A. So all it's left for me to say is thank you so much for attending this morning, and over to Sadiq and Rob to deal with the news item. Thank you both.
Thanks, Malcolm, and good morning, everyone. If you go on to the next slide, we'll get on to some direct tax news items. So it's the quiet before the budget, which we're all expecting to be quite heavy on tax announcements. That'll be on the 30th of October, so it's quiet before then. But what has happened recently is HMRC has been issuing a bunch of new nudge letters, which you might be aware of. Your clients might have brought some of these nudge letters into your attention. So there's 4 main ones. The first one's to wealthy individuals, and we recently did a tax e-zine on this, which you might have got through in your inbox on the 11th of September. Well, HMRC is starting to send out nudge letters to wealthy individuals. Wealthy individuals are those who earn 200,000 or above every year. The wealthy individuals would get a nudge letter if they haven't been registered for self-assessment, or they fail to file a 21-22 tax return, despite being issued a notice to file. So what's the risk for the clients? Clients who are not registered for self-assessment when they should be face significant tax-geared failure to notify penalties. So what we could do is help put things right for our clients. Despite HMRC's focus on filing returns, actually submitting the missing tax return may not be the most appropriate way to deal with these omissions. In most cases, if the person needs to file for more than 1 year or correct other tax mistakes, a voluntary disclosure is a much better way to approach HMRC. And there are different ways to doing this, depending on whether the client needs to obtain protection for criminal prosecution. BDO's tax dispute resolution team can support you on this. I know Piyush Patel has helped quite a lot of our clients with nudge letters, and he's a great contact. Just covering the other 3, child benefit nudge letters. HMRC is writing to individuals who may have declared the wrong amount of child benefit or omitted to declare it entirely. The letters are in reference to the 22-23 tax year, and recipients are being asked to check if their child benefit claim.
Anyone else? That's where I am.
Hi, Rob. Yep. To check their liabilities of the high income child benefit charge is correct. If you go on to the next one, the investors relief nudge letters, HMRC is investigating potentially erroneous claims for investors relief. So HMRC is writing to taxpayers who claimed investors relief in their 22-23 tax returns. One set of letters those to HMRC believes that did not qualify for relief. So they're asking to check their returns and make any corrections within 30 days. Remember, no action is actually needed if clients believe that their investors relief claim is actually correct. The last one is nudge letters on crypto assets. So HMRC is investigating potential instances of taxpayers failing to notify disposals of crypto assets. So HMRC is sending letters which informs taxpayers what is actually a disposal and when they need to inform HMRC by. So if anyone who believes that they have nothing to pay is asked to contact HMRC to explain the reason why and provide any supporting information why they haven't disclosed a crypto asset disposal. So they're the 4 nudge letters. Remember, it's not the equivalent of a formal inquiry, but it should be taken seriously, and you should take action if you believe your client's on the wrong side of HMRC. And if nothing needs to be corrected, sometimes it's better just to inform HMRC why and what the position is. That could prevent a costly formal inquiry in the future. That's it for direct taxes. I'm going to hand it over to Rob to talk about VAT.
Well, good morning, everybody. Apologies, nearly didn't make it. We just had a fire alarm in our Birmingham office, so we've all had to evacuate. So I'm going to listen on my laptop and my phone. 2 things I just want to talk about. Can you just check everyone can hear me first, okay? If someone can confirm.
Yes, I can hear you.
Yeah, that's fine. So I was having issues getting reconnected to the meeting. So the first one is probably the biggest talking point of VAT this summer, which is VAT on so it's
Your reception is very poor, Rob.
from
I think we can.
term starting after the 1st of January. And Malcolm, because unfortunately, is that better?
That's better, yeah.
Is that any better?
Yep, that's better.
Yeah, okay, right. Yeah, I'll carry on. Also, everyone, I'm connected to a laptop via my phone, which isn't the best signal, unfortunately. So it takes effect from the first term starting after the 1st of January 25, and there is anti-forestalling legislation is going to be introduced, so that any payments made after the 29th of July, which is the date of the announcement, that will carry VAT. And that was expected, because if you look at other similar provisions in the past, apart from the COVID measures, you remember 4 years ago from temporary reduced rates for hospitality, they've always introduced anti-forestalling legislation like this. But it's not necessarily as straightforward as it sounds. So when you look into the detail, obviously a private school is defined as a school that's where fees are paid for education. It also includes anybody that's closely connected to the main school bodies. So either this is closely bound by financial, economic and organisational links. So you may have heard that before. That's because it's similar to the disaggregation rules for that registration. But also anybody that's actually physically connected. So there's corporation tax definition of being connected. So if you've got a private school trying to say, well, we're grouping education through our subsidiary, that will be caught by this. It excludes nursery education, so anything up to the age of 4 will be excluded. But it also includes anything up to the age education up to the age of 19. So standalone sixth forms that charge fees for education will also be caught by these provisions. It includes boarding as well. So the legislation specifically includes any boarding provided that will now be subject to VAT. But any other closely related services are not included. So for instance, you may have food potentially, where food is not charged for separately, could be in theory potentially still exempt. And also includes special educational needs and disabilities education. And this is where it's placed by the local authority. So that's also included. Now, the potential challenges that maybe if you have these clients, the private school clients, you need to think about, firstly, is VAT registration. So for many of them, it's the first time they've ever had to register for VAT. And what HMRC is saying is that if you're not making taxable supplies at the moment, you can register from the 30th of October. If you are making taxable supplies but below the threshold, then you can start to register for VAT now. But the question you probably need to ask your clients is, when do you want to register for VAT? There may be reasons why you want to register slightly early. You may have costs that you've incurred recently that you want to claim the VAT on, potentially. VAT compliance as well. So setting up the accounting systems properly. So are the accounting systems fit for accounting for VAT? Or do we need to look at actually changing the system or putting things in place so that the VAT accounting can be done correctly? Input VAT, what can be claimed? What can be claimed input VAT wise? And potentially, can you claim pre-registration input tax? So goods up to 4 years, goods purchased it still on hand less than 4 years ago, or services less than 6 months ago. Will the school be partially exempt? So they may still have exempt activities. So potentially, if you've got sports fields that they're letting out for more than 28 days, potentially that will still remain exempt. And will the partial exemption special method be appropriate for a school that's partially exempt? And the big one, really, the big challenge that we're thinking about is the capital goods scheme. So if the school has spent more than 250,000 plus VAT in the previous 10 years, it may mean that they can now have positive adjustments, positive input back recovery on those improvements. And obviously, at BDO, we have a lot of experience in this sector, in the education sector, that in the education sector. And we can assist any clients that you may have, or assist you with your clients with these challenges. As I say, it's the biggest talking point in the summer, and it's coming in from January 25. The other one I just want to mention briefly is the report of repayment fraud. So HMRC became aware that large amounts of paper form VAT 484s, that's the paper form to change your business details, were being submitted to change bank details. And they've worked out that actually these are fraudulent people actually trying to change the bank details fraudulently so they can then siphon off VAT refunds from repayment traders. So from the 5th of August, HMRC stated that they'll no longer accept the paper VAT 484 to change your bank detail, and you have to do it through the HMRC portal. So really, it's a good reminder to get your clients to make sure they still have access to the HMRC portal. You'd be amazed the amount of clients I have that don't and have to restore it. And secondly, make sure that the bank details on the HMRC account are correct and that they haven't been changed, and they are still receiving the refunds of the repayment traders that they are expecting. Okay, Malcolm, back to you.
Thank you, Rob. See if I can turn my video back on so you can see me. Don't have any questions in the Q&A at the moment. Stuart, you've got your hand raised. If that means you've got a question, could you type it into the Q&A, please, and we'll pick it up with the next available opportunity. That would be great, thanks. Time is moving on, so I think we will now pass over to Paul and Ashley. Thank you both. Over to you.
Great, thank you, Malcolm. So I think Paul's just had to evacuate the building in Birmingham for fire alarm. So I'm just going to pick up the intro and hopefully he can join us towards the end, given that I'm in a different office, thankfully. So this session just focuses around potentially looking at the changes which might be coming in the upcoming budget. Obviously, there's been much speculation around what might happen broadly in relation to capital gains tax and inheritance taxes, which have been the main areas of focus, really. Nothing confirmed yet, but we thought this session would be useful just to kind of lay out the current treatment of how transactions work in terms of consideration received, what you can do in terms of transactions which might have already happened, potentially, is there any option to hedge your bets against what might happen in the budget? And then in terms of the extent that rates do rise, what kind of things are we seeing? What kind of planning points might you consider to try and kind of combat the increases and keep capital gains tax paid to a minimum where possible? So I suppose we go to the next slide, please, and then we'll kick off just in terms of an overview of the current position. So in terms of consideration, we thought it might be useful just to touch on how consideration is taxed on a typical business sale. So typically, you might see either cash or you might see a mixture of cash and deferred consideration, cash and security is being received. So the examples I'm about to run through, it's assumed that all these are chargeable to capital gains tax. There can be complications in earn-out scenarios where the employment of the person receiving the earn-out continues, and there may be income tax consequences because of that, but we're not touching on these today. So just a brief overview, starting with cash. So cash immediately subject to capital gains. So no discount for cash in terms of contingent liabilities, which might be written into the share purchase agreement, such as warranties. To the extent these do come enforceable in future periods, you have 4 years to recompute from the point they come enforceable. The main point with cash is that because it's immediately taxable on disposal of the shares, you may qualify for business asset disposal relief on the disposal of your personal trading company, obviously subject to meter requirements there, which means that you might qualify 10% capital gains tax up to $1 million, or potentially 20% if you don't qualify for BADR, or thereafter the first $1 million. So you might see cash on its own, or again, you might see cash with a mix of other types of consideration. So shares or non-qualifying corporate bonds, something we see quite a lot of. So generally in takeover situations where you're meeting the conditions, so you're acquiring companies, acquiring enough of your entity and is doing it for bona fide commercial purposes. Often you'll be able to roll over the gain on your old securities into the base cost of your new securities received in the acquiring company. So something that you have to consider here is generally, if you do want this rollover treatment, are you going to apply for tax clearance on that with HMRC to make sure they don't disagree with your evaluation of the automatic treatment of rollover? And then also consider the fact that these shares or non-qualifying corporate bonds that you might be receiving, when you come to the second disposal, because that's when the gain will rise because you've rolled your gain over, will they qualify for business asset disposal relief at that point? Or if not, is there an opportunity to disapply the rollover treatment based on the original disposal to then crystallise the gain subject to business asset disposal relief? So you have to look at that within 1 year of the 31st of January following tax year of your original disposal. Qualifying corporate bonds, broadly similar, however, they're more akin to debt. So rather than the gain being rolled over here, it's just simply held over. So the gain crystallises, but it's not assessed until you either redeem the bonds or dispose of the bonds in future periods. Potentially, it may qualify for business asset disposal relief, but only to the extent that you still have shares in the personal trading company at that point in time that will qualify. If they wouldn't qualify, then again, consider disapplying the original holdover of the gain across to the QCBs within 1 year from the 31st of January of the year of disposal to crystallise the gain at that point in time. In terms of earnouts then, so typically you'll see a few different types of earnouts, which we'll touch on now. So firstly, earnouts in shares and securities. So an earnout is actually not shares itself, but so it doesn't specifically qualify for rollover treatment, but where an earnout will be satisfied in shares or loan notes in the future, HMRC, subject to meeting the qualifying criteria, will apply that rollover treatment. So your gain will roll over into the deferred shares or securities, and then you'll be taxed on the second disposal when you come to sell those. Again, similar to shares or non-QCBs up front, you need to consider if you will qualify for business asset disposal relief on that second disposal. If not, opportunity to potentially disapply the rollover treatment based on the original disposal date to crystallise that gain. So you then get the gain such as business asset disposal relief rather than not meeting it. And again, if you want the rollover treatment, always try and apply for tax clearance to make sure HMRC doesn't disagree with your evaluation of the position. Just considering earnouts in terms of cash, so generally where you've got a fixed cash earnout, it's treated broadly the same as upfront cash. So your whole cash amount will be taxed upfront and immediately subject to tax. Something to consider here is you don't get a discount for the instalments, even though they may be paid months, years in the future. So it's all immediately subject to tax, which can leave you with potentially a dry tax charge that you need to consider. Something HMRC has got in place and you can apply for to help your clients here, or potentially apply for instalments payments in terms of the deferred payments of the cash earnout, which will broadly, if your earnout period
I'm convinced when I was off, I think it was COVID as well.
Can you meet your mic, please? Cheers. So when you're over 18 months, you can apply for instalment payments with HMRC, which means that you can broadly align your tax payments to your tax charges when you actually receive the future consideration. And then finally, what we've got is earnouts in cash that are unsustainable. So depending on future events, you're not quite sure what the earnout is going to be. But what you'll do is, because the earnout is a chosen action, it's the right to retain future consideration at a future point in time. You'll work out how much that right may be worth, discounting it for basic discount measures like risk and the time value of money and so on, bringing that discounted earnout value into the charge immediately, which potentially will qualify for BADR alongside the initial disposal. But then when you receive earnout payments in the future, you will then look at the base cost of the earnout that you acquired, so the right you acquired, versus the consideration you're getting in at that point in time when the earnout's paid. And at that point, you will either have a capital gain or capital loss, which will either be taxable in full or may be able to be carried back against previous capital gains tax, subject to making carryback claim. So those are just a few of the initial types that we want to touch on, and then we should go to the next slide, please. We just want to look at, in terms of the budget itself, so what do we know so far in terms of what might happen with capital gains tax and IHT? So truthfully, we don't really know much. Rachel Reeves has basically said that she's not going to rule out tax rises in terms of capital gains and inheritance tax. So what we've done is just have a think about what kind of things could come up that we might see. Obviously, these are just speculation, and any kind of planning needs to be done considering your own, in terms of your own client's position. But broadly, in terms of capital gains tax, could we see capital gains being aligned to income tax banding? So higher rate people pay high rate capital gains tax. Could we just see a flat rate tax increase to say 30% for capital gains? Could we see some kind of tapering similar to the US system, where the longer you hold on to an asset, the reduction in capital gains tax rates will follow that in terms of tapering? And then could we see some kind of CGT disposal on death in addition to inheritance tax? One of the key points here is that Rachel Reeves has admitted in the past that many business owners do use their personal companies as almost like a pension pot. So we might see some softening of any rate rises for those people in form of an extension of business asset disposal relief, although the bottom rate of 10% may be unlikely to stay at that. In terms of inheritance tax, just a few ideas. It might be we have the exemption for the passing on of pensions on death removed. We could have progressive inheritance tax bands. The larger the estate, the larger the IHT rate. And the key one that people are most concerned about is reducing or capping business relief, so 100% relief from inheritance tax or agricultural relief on farming assets. And that could be either through tightening the criteria, so potentially increasing the trading threshold for a business, or saying that AIM shares no longer qualify for business relief, or less active farmers aren't included in terms of agricultural relief. Other measures, they could include limits on annual gift relief, for example, or reduce the amount of potentially exempt transfers available to you. Traditionally, when changes come in, they'll do it in the Finance Act. So it could be from 6th of April 25 that changes come in. However, we have seen before that changes do come in budget day. So we should go to the next slide. One of the things we want to touch on is what we've seen before in terms of anti-forestalling measures. So broadly, anti-forestalling is where people are trying to hedge their bets about what might happen on budget day. So potentially putting measures in place where if it doesn't go your way and rates rise or allowances decrease, can we still retain those by either changing transactions in terms of making elections or kind of planning beforehand? So the main one that we've seen was the change from entrepreneurs relief to business asset disposal relief in March 2020. So that actually changed on the 11th of March 2020. So the change was mainly that the lifetime allowance reduced from £10 million to £1 million, 10%. So quite a large increase in the tax bill just overnight for those people that had significant gains qualifying for business asset disposal relief. In terms of the measures that were put in place, broadly looked at countering kind of non-commercial arrangements. So the first one was regarding unconditional contracts or rescindable contracts. So generally for capital gains, your contract date is the date of disposal. but you can't have a capital gains transaction unless you actually complete the contract and convey it. So we were having situations where people were having contracts put in place unconditionally, pre-budget. A related party or third party may stand on contract up until post the budget date, and then post the budget date, if the budget didn't go your way, you will complete the contract with the view to trying to retain your contract date for business asset disposal relief purposes, which will be pre-budget, and retain the 10 million. HMRC brought in anti-forestalling, which basically said that if you're looking at doing this, we'll change your date of disposal for business asset disposal relief purposes only to the conveyance date, which meant that it was post-budget, and therefore anti-forestalling gave you the lower amount. In addition, another significant one was in regard to reorganisation share capital, importantly, on or after 6th of April 2019, so obviously the tax year of the budget itself. So in terms of this was broadly where you would have a transaction where you might be looking to put a holding company in place, or you might be looking to have more share capital in an acquirer. When you do that, as we said before, your gain would roll over into the base cost of the new securities received, and then you would have until if you're doing it.
Ashley, can you slow down a little bit?
Yeah, sorry. Yeah,
people understand. Cheers, mate.
Sure. So if you were doing this pre-budget, obviously you would defer your gain into the base cost of new shares, and then you would have up until the first anniversary, the 31st of January from the year of the rollover to disapply the rollover treatment, which meant you could actually look at doing it post-budget. Now, HMRC basically said that if you're doing that and it's been on broadly a non-commercial basis, that the anti-forestalling rules, rather than the Section 6196Q election applying to the original disposal date pre-budget, it would apply to the actual date of the election post-budget, which meant that you only got the £1 million lifetime limit for your business asset disposal relief. Importantly here, there was no anti-forestalling for Section 169QR, which was for qualifying corporate bonds, and also it was only on reorganisations post 6th of April. So they still had, for those reorganisations, to elect by 31st of Jan 21. So we go to the next slide. In terms of planning for transactions which might have already happened, so clients may wish to disapply the rollover or holdover provisions, as we just discussed, in terms of banking their business asset disposal relief, for instance, or the current tax rates at the time of those disposals. Importantly, if you would look into disapply, you need to qualify for business asset disposal relief because the rules are within Section 169, which is that section of legislation. And then in terms of non-qualifying corporate bonds, loan and securities, so the election is under 169Q to disapply that side in terms of chair or loan consideration received. If anti-forestalling comes in the same form that it did back in 2020, then hopefully any transactions done in the year to 5th of April may sit outside of the anti-forestalling. So potentially you might have up until 31st of Jan 2025 to make decisions there, or potentially if you're looking at hedging, what might happen is making the election before the budget date itself. In terms of QCBs, as before, if anti-forestalling was done the same measure, hopefully that will remain the same. So it shouldn't be any anti-forestalling there, fingers crossed. And then considerations in terms of both of these measures. So disapplication is an all or nothing election. All the gains brought into charge. So consider, can your client actually meet the drawing tax charge that may arise, and any late payment interest on that tax charge itself. The time limit for making these elections is the first of the year, 1 year from the 31st of January from the year of the exchange. Okay, we go to the next slide, please. So what are our options should rates rise? So capital gains are longer term generally. So you can just hold on to your assets and wait it out in the hope that the capital gains rates will reduce in future. Clients may consider going non-resident. So in terms of if they've considered living abroad, lifestyle changes may produce tax benefit to your non-resident. They may wish to sell at subsidiary level, so realise funds from the sale and then decide what to do with these funds in the top company at a later date, maybe liquidate it. Or they may just want to change and get out of one business and reinvest into another. In terms of sell a subsidiary and then reinvest elsewhere. The important thing here is that if you sell a subsidiary, it will either be charged with corporation tax 25%, or it may be exempt from corporation tax subject to meeting the substantial shareholding exemption. And then another thing which potentially clients may consider doing is a tax-free disposal to a employee ownership trust. You may be able to get market value sale here. Consideration including, can the subsidiary actually end up, and the company actually end up repaying you out of its post-tax profits, gives you the opportunity to stay on with the company, potentially benefits for employees, but obviously qualifying conditions to meet tax purposes for the EOT sale itself. And then we'll just look at a few in detail. So we go to the next slide. One of the more popular ones at the moment, planning idea, is going non-resident. So to the extent that you're not UK resident, then you shouldn't be subject to UK capital gains tax on disposals in the years of non-residence, which is quite an attractive thing to have in terms of escaping the UK tax net. So when you're looking at going non-resident, one of the things you will need to consider is making sure that you stay non-resident. So the statutory residence tests are established tests which give you certainty about your residency position from a UK perspective. They're complex, require detailed record keeping, but they can give your clients certainty that they won't be in the UK tax net on their disposals. Importantly, they must cease to be resident ahead of the disposal. If potentially they can't leave the UK before the 5th of April, consider before the year of disposal, consider if they can have a split year potentially where they're working full-time abroad or they no longer have a UK home. There is avoidance, however, regarding the non-residence position. So the temporary non-residence provisions will apply. So where they dispose of an asset which they had in the year of departure and they're not non-resident for a year, for at least 5 tax years or potentially 6 years, or you go split non-resident a year, then if they come back within that period, then potentially the whole game will be subject to UK tax on the year of arrival. Again, not all assets will be exempt from UK capital gains tax. There are non-resident capital gains tax provisions in relation to direct and indirect sales of UK land and property, although you should get a rebasing to 2019 values on those, although they still will be caught during periods of non-residence. If you want to go non-resident, but for whatever reason you might not be able to do it straight away, there's also a consideration of, can you sell at subsidiary level and then go non-resident in future and liquidate the top code once non-resident. In terms of where people are going, it's broadly looking at going to Dubai, for instance, where there's no personal tax, and then also Spain, where they have Beckham's law, where broadly your income from overseas outside of Spain is tax exempt for a number of years post obtaining Spanish residence. So importantly, tax should not be the only driver. You need to stay outside the UK for a significant period of time for this to work, and it's a big commitment. No point being rich and miserable outside the UK, even on the sun lounger. So next slide, please. In terms of other stuff we might see, so mentioned before, sale of a subsidiary company. So a sale of a subsidiary company, if personal tax and capital gains tax rates rise, they may decide to sell at a lower level to keep the funds in top companies. Potentially, this can be done tax-free, where you've got substantial shareholding in the subsidiary company. You've held that for a 12-month period and over the last 6 years to their disposal, broadly over 10% of the company's already share capital. The investee company needs to be a qualifying company, which broadly just means it's a trading company. Trading company meaning not non-trading to a substantial extent, broadly 20% of the assets in terms of trading assets, either on balance sheet or off balance sheet goodwill. The activities that the company engaged into and management time needs to be less, not non-trading, so it needs to be at least 80% trading. HMRC will look at quantitative and qualitative definitions, but broadly, if you meet the SC requirements, the disposal of the subsidiary should be exempt from corporate tax. So we move on to the next slide, please. In terms of planning ideas, so it might be that you've got a group and your group has a subsidiary which you're trading, but you don't want to dispose of all of the subsidiary. There's a hive down extension for substantial holding exemption, which broadly says where you've been trading, but trade within the group for 12 months or more. If you hive it down into a new company, then it's broadly you get to treat the new company as being held for 12 months and trading for 12 months, and then you can then sell it and cover any degrouping charge for SSC, and obviously the disposal of the subsidiary itself will be covered by substantial shareholding exemption. Something to consider here, though, is that you can't do this as singleton companies, so you can't just hide down to a new subsidiary if there wasn't a capital gains group there beforehand. HMRC has recently challenged them Holdings Limited here because they did this effectively and now has a substantial tax bill they have to pay. In terms of what you should be considering here, therefore, is if you've got singleton companies, advancing wanting to potentially utilise SSE, looking to either put a holding company in place, obviously subject to achieving tax clearance, or incorporating dormant subsidiaries, ready for the point where the point ticks over, the 12 months have elapsed, and potentially you meet the qualifying criteria for SSE. Okay, next slide, please. In terms of SSE and deferred consideration, so the way this works is broadly ascertainable consideration is all taxed up front as part of the initial gain, so covered by the substantial shareholding exemption. Unascertainable consideration for SSC, so we like to bridge the gap between buyers and sellers by offering some kind of deferred consideration, which will be based on profit measures, for instance. Generally, as before, you'll bring in a discounted chosen option up front, which will be covered by SSC, and then when the earnouts are received in future periods, you'll have a future taxable gain or loss, depending on the value received and the value you thought you were going to receive, which isn't covered by the substantial shareholding exemption. So this can actually leave a bit of a gap, which means that partially some of the proceeds earned out are taxable or create a capital loss. So a planning idea here is broadly using profit warranties instead of earnouts. So can we tax all of our proceeds up front? We calculate the top end of the earnout and just give it an upfront consideration. And then to the extent that we don't meet certain profit levels as per the SPA, we will reduce the profits in future to reduce the amount of proceeds basically we're receiving. The benefit of this is everything's taxed up front and qualifies for the SSC. In terms of rollover consideration, how this works for SSC, so if you were receiving shares instead, broadly, if the SSC provisions are met, then it will override any shares received and you'll have an uplift to market value in terms of the shares that you receive, instead of rolling them over against the base cost of the shares acquired. So a few planning ideas here, and then we just want to touch on finally, on the next slide, what we're seeing at the moment in the market. So clients are generally trying to accelerate deals and liquidations. Obviously, they want to try and do this pre-budget to try and lock in pre-budget rates and allowances. Where they're considering going non-resident, making sure their ducks in line in terms of getting ready to move abroad, either for personal matters, business matters, or so on. Restructuring to facilitate a future sale to subsidiary. Obviously, they may only want to sell part of a business, so figure out what part that is, hiring it down, looking at pre-packaging the group or the subgroups and making sure they qualify under the trading requirements, or looking at the assets they currently hold. If they, for instance, high levels of investments or cash not held for working capital, what can we do with this to make sure that we meet the SSE requirements when we come to sell? And then obviously we're not touching inheritance tax in detail here, but something a lot of people are considering a lot is what kind of funds they need in future, want to provide for their dependents in terms of settling these into trust pre-budget, where unquoted trading company shares potentially qualify 100% business relief from inheritance tax, just in case business relief changes post-budget. So those are the broad points we want to touch on. I think let's pause on now. I will hand back to Malcolm, if that's okay.
Yeah, thank you. Ashley, if you could just stay on audio and visual for a moment. Just have a question for you. Where the consideration is paid by installments, is it possible to pay the tax by installments? And if so, does interest apply to that to those payments of tax?
So it's definitely possible to pay the tax installments, and the way that it works is when the installment's due, the tax falls due. In terms of interest, I'm not sure, Paul, is that something you know in terms of tax installments?
No, I'm not sure. We've got you're talking about where we've got deferred payments.
Yes, that's right, Paul.
Deferred payments, and doesn't it go by the revenue concession? Basically, the amount you've got to pay. If you've got the cash, then they expect you to give them the tax largely.
That's right.
I think that's broadly how it works. But then I think it might not be interest. Is that right, Malcolm?
I'm not sure, to be honest.
I'm not sure. I'm not sure.
Off the top of my
I
head.
want to guess.
No, not going to.
We don't get it very often because very few people have consideration such that the amount they get received up front is not more than the tax. So the revenue say, well, if you've got the cash, we'll have it. Thank you.
We'll have it. What we'll do, Leslie, it's your question. We'll look that one up and email you the answer.
Happy to.
Lovely. Thank you. Thank you both. Appreciate that Ashley covered up an awful lot of stuff there. If you've got any questions for him, his contact details are in the slide pack, or for Paul, for that matter. Do drop them an email or give them a call, and I'm sure they will be able to assist you further. So thank you both very much indeed. Thank you, Ashley. Thank you, Paul.
Thank you, Ashley.
And next slide, please. And we're now over to Radhika to frighten us all about non-domiciles. So Radhika, over to you, please.
Hi, Malcolm. Thank you very much. So I'm Radhika Cater, and I'm one of BDO's non-dom specialists. I'm just going to talk to you about updates released in Labour's policy paper over the summer. It's going to be quite a high-level overview, focusing on those updates specifically, but there is so much unknown at this stage, so it is quite difficult to give a full update, but I'm happy to take any questions via the chat at the end. So as you'll know, the rules for non-doms have been a hot topic in recent years. And in the last 6 months, we've had the spring budget, the general election, and then the Labour policy paper that was released on the 29th of July, all focusing on the overhaul of the current regime with lots of ideas put forward, but what actually sticks and comes into force is still unknown. So looking at the Labour policy paper update, this confirmed that while some policies announced in the spring budget would go ahead, some will not, with others being reviewed to ensure the regime is both fair and as competitive as possible. So just move on to the slide, please. So the key date now, as it is for everyone that's spoken today, is the 30th of October and the autumn budget, where we expect announcements, and we also expect full legislation in respect to these changes. So that would be a great thing if we do actually get the full legislation. HMRC held various listening events both before and after the general election, where professional bodies and interested parties were able to put across thoughts and questions for the government to consider. Whilst there wasn't any insight gained from these sessions, it is hoped that some of the key points raised will be taken on board. So currently, individuals who are domiciled outside the UK are not deemed to be domiciled. So that means when they've been here for 15 out of the last 20 tax years, they can benefit from a regime which sees their non-UK income and gains that are to be outside the scope of UK tax unless they are brought to the UK, and also non-UK cited assets will be outside the scope of IHT. So from 6th of April, the current remittance basis regime for non-domiciles will be completely abolished and replaced with a residence-based regime, which will see all UK residents taxed on worldwide income and gains. There will be an exemption to this for individuals moving to the UK, and this exemption will apply for 4 years from becoming UK resident and will be known as the 4-year income and gain, or the FIG regime. We expect this exemption to be available to individuals who have not been resident in the UK in the last 10 years. It's yet to be confirmed whether this will apply to individuals who have a domicile in the UK, so potentially, people who've been here for a number of years and then maybe retired overseas and now are thinking of coming back to the UK, but they've been out for, say, 15 years. It's anticipated that foreign income and gains will not be subject to UK tax during the exemption period, that these funds can be brought to the UK freely. So that's quite a big departure from what the current remittance basis rules are like. The Labour Party have confirmed that there will be transitional provisions, but we expect these to be less generous than what was proposed under the Conservative government. And the new rules will also see a shake-up to the taxation of offshore trusts and inheritance tax regime, moving to a resident-based approach there as well. So just moving on to the next slide, please. This is just looking at the transitional reliefs. And so the Labour government are looking to introduce a temporary repatriation facility, and this would be a mechanism for historic remittance basis users, potentially including those who are already deemed domiciled in the UK, to bring their foreign income and gain that was covered by the remittance basis to the UK at reduced rates of tax. The mechanisms of how this will work are yet to be seen, but the policy paper did mention that the government will want to make the facility as attractive as possible and that it could be extended past the 2-year period that was proposed in the spring budget. And they're looking at how the facility could be extended to trusts. Details on whether it will be extended to stockpiled income and gains and offshore structures is due to be confirmed in the budget, and this will be a really big factor, I think, for a number of individuals. The previous government had proposed a rate of 12% for the temporary repatriation facility, and we are waiting to see if the current government will go with this rate or change it. So another relief, the government are also intending to introduce rebasing relief for those who are not yet deemed domiciled. As was the case with April 2017, we expect to see these rules allow individuals to reset the base cost of their assets to the market value at a set date. Previously, it was said that the date of rebasing would be April 2019. However, the current government have said that the date for rebasing is yet to be confirmed, and we expect to hear this date in the budget. Unlike the previous government, the current government have confirmed that they will not introduce the 50% reduction in foreign taxable income for individuals losing access to the remittance basis from 6th of April 2025. So this is obviously quite a big departure from what was announced in the spring budget. And finally, we understand that there may be some transitional rules for trusts. Again, no further details are available in respect to this, so we wait to hear on that. So we just move to the next slide and just to touch on inheritance tax. So in the spring budget, it was understood that there would be a consultation on changes to the IHT regime. However, it was then announced in the policy paper that current government have confirmed that they will not be looking to do a consultation, and instead they will review any stakeholder feedback that has been received. So it's expected that from the 6th of April 25, the IHT regime will move to a residence-based approach, seeing individuals who have been in the UK for 10 years or more falling within the scope of IHT. So this is quite a big change from where you had the deemed domicile rules, which triggered at 15 years. So this is kind of accelerating the position to 5 years earlier. And in connection to this, individuals who leave the UK will remain within the IHT net for 10 years if they have been UK resident for 10 years. It's unknown if individuals that leave ahead of the 6th of April 2025 will be caught by this regime or not. But one thing that has been confirmed is that for deaths occurring before the 6th of April, these will all fall within the current regime. A handful of double tax treaties with the UK rely on domicile status, and it's not based on residence. So we'll wait to see how the changes to the UK domestic law will impact these treaties. One of the biggest changes, and certainly one of the things we get asked the most about, is in relation to excluded property trusts, which are trusts set up by non-UK domiciled using non-UK assets, which are outside the scope of IHT and do remain outside the scope of IHT under the current rules, even when that individual becomes UK deemed domiciled, is that these trusts will lose the status and come within the IHT net. Again, and sorry, I feel like I'm repeating myself, but again, we don't know exactly how this is going to work and what the extent of this is, but it is a significant change, and potentially we'll see individuals with settlor interested trusts now having all trust assets within their estates. And I think this is probably the biggest concern that we are seeing with our client base. And so if you just move on to the next slide. On the topic of trust changes, trust protections, which previously afforded those who are deemed domiciled protection from income tax and capital gains tax on what was going on within the trust, will be lost to all of those that don't qualify for the 4-year foreign income and gains rules. This means that from the 6th of April 25, settlor interested trusts will see the settlor assessed on that income and gains. Again, how this works in practice is unknown. Whether factors such as foreign taxes paid by the trust will be allowable as a tax credit for the settlor is yet to be seen. The trust rules are expected to change even more as the transfer of asset rules are under review, though this isn't expected to come into play until the 6th of April 2026. So it's an ever moving feat here with the offshore trusts. So we just move on to what I think is the final slide now. Okay, so sorry, there is actually one other bit. Sorry, I thought there was another slide, but just a bit about what's going on now and what we're seeing with our clients. So in terms of our client base, there are a few taking significant action now, but a large proportion, like us, are waiting for the budget on October 30th. In the background, they are getting their tax affairs in order and thinking of contingency plans should the outcome of the budget not be to their liking. So like Ashley said, leaving the UK is on a lot of people's mind. And the key question we're asked is where we should go if I leave the UK. And again, I think you've got the main sort of suspects there, Spain, Italy, and you've also got Switzerland as option and Portugal. So a recent Wealth report suggests actually that we might see as many as 9,500 millionaires leave the UK this year, which is double what happened in 2023. So it is definitely on a lot of people's mind. And we work with our BDO networks to provide advice in those jurisdictions. A recent media article, which some of you may have seen, was that there's a lot of speculation about whether there could be an exit tax to catch the wealthy who are leaving. It is merely speculation, and I think there's a lot of thought goes into the design of a wealthy tax, but we'll wait to see if there is something on that. And again, like Ashley said, ultimately tax, whilst a component of the puzzle, is rarely the sole consideration for an overseas move. And there are so many factors that an individual and their family will have to consider. So it's a big choice. So I hope that's been helpful with just a bit of an update on what we saw in the policy paper. And I'll hand back to you now, Malcolm.
Okay. You've prompted a couple of questions. So let's see how we go. Try your best. It's a question here about the remittance basis charge.
Yes.
If the first year of residence is 2019, how does the remittance charge work?
So if you've got under the current rules, how does it work? So if you've got 2019, so you've got until you've been UK resident for 7 out of the last 9 years, you won't be subject to the remittance basis charge. So doing my maths, I think you might never be subject to the remittance basis charge because you won't have reached 7 years by the time the new rules come in, and you won't qualify for the 4-year FIG rule. So if my maths is right, and I hope it is, I think there may never be a remittance basis charge for that individual. They'll be able to benefit from the free remittance charge up to the 6th of April 2025. Okay,
thank you for that, Radhika. And a question here about why move to Portugal. They've pulled their non-habitual residence regime. So I don't know if you have any thoughts on that.
So I think the plan was for it to be removed, but I believe that there is still going to be a non-habitual residence regime. I think there's been like a lot of back and forth on that, but there is going to be some regime. So perhaps that's something I can follow up with this person on, because I do think we have some information from our counterparts in BDO Portugal.
Okay. I'll send you the details of the question. Lovely. And one final one. Says inheritance tax is not payable in India. And so if an individual lives in the UK but has dual nationality, will they be subject to IHT or not under new proposals due to living in the UK? So I think that's a question about the impact with the
double tax treaty.
Double tax treaty.
Yeah, and I think that this is a really, really valid point, because the double tax treaty does refer to domicile as opposed to residence, and whether that will still remain the case that they'll still be looking at domicile, even though we've moved to a residence-based regime, is yet to be confirmed. Domicile will always be a concept. It just may not be a domestic law tax concept. It may still be relevant for international law, or it could be that those treaties are updated as they are quite old. And I think there has been talk about that for some time. So I think, unfortunately, it's a watch this space, and let's see what happens.
Okay, thank you. And I think we've exhausted all the questions. So thank you very much, Radhika. Prompted a lot of interest. Well done. So we're coming up to nearly 11 o'clock, so we're nearly coming up to time. So thank you all for attending today. It's been really interesting sessions, and thank you for all your questions. If you have got any further questions, do call any of the speakers. The contact details are in the pack, or you can email taxline@bdo.co.uk, and we'll pick up the queries from there. If you want to know more about the Taxline telephone helpline, again, please do email taxline@bdo.co.uk, and we can get back to you on that. A reminder that our next webinar is on Wednesday, the 16th of October. It's in the afternoon at 2 p.m. So do please look out for the invitation, which will be going out in the next few days. The slides and the recording of this event will also be going out probably in the next 3 or 4 days once we've pulled it all together. So you'll have it ready to hand. And finally, thank you once again for attending. Some really good numbers. Thank you all, and have a good rest of the day. Thank you very much.